is the Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today I'm here with Jonathan Loewenhar, founder and managing partner of Enjoy the Work, a consulting firm that helps founders master the skills they need to become great CEOs. Enjoy the Work works with startups across the globe, providing expert guidance to founders on how to build high-performing companies. Jonathan, thank you for joining us.
I am so glad to be here.
Great. And so where does this podcast find you today?
I live in a tiny town just south of San Francisco called Brisbane. Proud
Wow.
of the 5,000 little residents that we have here locally. If you know the Bay Area, we're halfway between SFO and the city.
Cool. Well, you've had an impressive career. You built a $1 billion business segment, leading successful turnarounds and guiding great startups to great exits and so forth. Can you tell us more about your background and the experiences that, led you to create Enjoy the Work?
Well, I've been an operator a long time. I'm an experienced operator. That's a euphemism for being old. So I started my career in big companies and I worked my way up the ladder, sales roles and marketing roles and analytics roles until I was running, a $1 billion division for a large public company. Then I had a chance to be a private equity operator overseeing a business that had a few thousand employees, like $150 million in revenue. I didn't want to live where I was living anymore at the time. I was in Nevada and I moved to the Bay Area in 2007. My memory's a little bit challenged. And I did back-to-back startups. The first one did not work. We ended up selling, raised a couple of rounds of venture. I sold the company. And so I sold the venture-backed startup. I made like $7 in a bag of potato chips. But it had me fall in love with startup life. And I immediately joined another one. This next one did work. I was the first non-founder president of the business. And that company went on, I grew it to its first $20 million in revenue, or helped grow it to its first $20 million in revenue. And then eventually that business was acquired by SAP for just under $1 billion. What led me to Enjoy the Work was this kind of crazy pattern that seemed true to me, but my sample set was small. I had run a public division, a private equity holding company, a tiny startup, and a growth stage startup. And when companies were run well, and all four of them got to a place where they were eventually run well, they all looked the same. We did all the same things in the same rituals with the same rhythms. And so I started to ask myself the question of do all well-run companies look the same? I have tested that question now obsessively, and the answer is yes. All well-run companies have the same frickin' rhythm. They all have mission, vision, and values clearly articulated. People know why they're working there. There's some milestone they're working backwards from. There's some goal-setting infrastructure in place to know what matters most now. There's some communication structure in place so the left hand talks to the right hand and knowledge is institutionalized. There's some values in place so that when interpersonal conflict and behavioral conflict shows up, it can be eradicated quickly. All the same things are in place. So if that's true, how does a company go from being poorly run to well run and in startup life as the company's just getting started? So those were kind of the beginning seeds. I can keep going, Hall. I've had a lot of caffeine, but stop me if you want me to go elsewhere.
Well, one of the central themes of your work is helping founders transition into effective CEOs. What do you see as the biggest difference between being a founder and being a manager? I mean, how do you help founders make that shift?
So on that same path that I was describing, I started to interview investors obsessively because I was curious. They speak to a lot of founders, they speak to a lot of CEOs. So this is 2015, by the way, where I am in my career at this point. And I began to ask investors 3 questions, and the exact same 3 over and over and over again. First question, what makes a great founder? And what was surprising to me in the moment, maybe not in retrospect, is that everyone had the same answer. Everyone kept saying the same thing. They used words that meant grit and tenacity and courage and insight. So then I asked question number 2, what makes a great CEO? And they used none of those words, Hall. I said, okay, what makes a great startup CEO? And they would talk about skills. This is someone who knows how to build things and sell things or recruit people and raise capital and organize humans and financial plan. So I'd ask question number 3. Well, how does a founder learn those skills while doing the job? And I got blank stares. Over and over again, I got blank stares. 2 years of asking those questions, what ended up having me conclude was to be a startup CEO was the highest paying job I could find in the world without training or pedagogy. We simply ask our founders, hey, I hope you ask the right questions at the right time of the right sources, or you're fired, or your company won't succeed, which was bananas to me. Being a founder is about attributes. Being a CEO is about skills, but we don't teach the skills. So that's what led me to enjoy the work, because I believed all those skills could be taught. That in fact, there is a giant difference between starting a company versus growing a company versus scaling a company versus exiting a company. And there are different skills that you need to acquire as CEO along the way if you want to keep the job the whole time.
So, in your experience, what are the most common mistakes founders make when they try to shift into a managerial role?
Obviously, there's difference between the first timer and the second timer. We have across the roster of CEOs that we work with, we have some that are in their mid 50s and they're on their fourth company with multiple exits in their past. And we have others that are 22-year-olds doing all this for the first time. So they make different mistakes. But if I would generalize, I'd say it's four things. One is founders don't understand in the beginning, they don't understand this idea of leverage. So they try and do everything themselves, including tasks that are low leverage that will simply increment some task in the business versus high leverage, things that will change the trajectory of the company. Said differently, they don't understand the difference between working in the business versus working on the business and how much more impactful the latter is. Second, most founders, oh, that's not fair. Many founders fall prey to one of the classic CEO mistakes. We've listed them all. We talk about them all regularly in our firm. But one of this is the idea of the laissez-faire CEO, where they have this broken and insane yet rational sounding belief that if I just hire amazing humans, I can just let them go and they will do the right work and the company will achieve. And I have never met anyone that didn't benefit from good management. And what the CEO knows that their execs don't know is the CEO sees the whole playing field. They're the queen of the chessboard. They can make every move. They see all of the competitors, the risks, the opportunities. And so this brings us back to like the third thing that I often see them make a mistake because they're related is what the first time CEO often doesn't see as they go from being founder to manager or founder to CEO is their job increasingly is about comms, good communication. Why are we doing a thing? When are we doing it? Who's doing it? Have we reached an agreement about doing it? How do we make sure that knowledge that gets gathered in the company is institutionalized? Things that we gather from our clients or from our partners or from our investors or from our colleagues gets shared when they need to be shared and where and when. And I'm not saying the CEO needs to press all the buttons and create Notion pages, but they do need to be responsible for how is communication done around here. Fourth, they don't understand the difference, or the mistake they make is the difference in there are two stages to the startup journey and they only obsess about one. And then they have a moment of shock. Stage one, build something people want to buy, like old Steve Blank, Paul Graham stuff that is powerful as today as it was when it was written. Stage two, build company around the thing people want to buy. And founders don't think about the second one until it like punches them in the face. And that is a shift from being an inventor to looking to create a repeatable factory of the thing you're trying to move into the world. And that is a change in mindset for how to run the business. And again, I'm not trying to rip out founder magic. They're inventors, they're magicians. But if they don't bring on the second skill, then their company will stay acute invention as opposed to becoming a sustainable business. Those are the four big ones to me.
So how does the leadership style of a founder differ from that of a professional CEO who may be brought in later? There are areas where founders tend to struggle more than CEOs with a traditional managerial background.
I think there are trade-offs to the two. Most outside succession doesn't work. The failure rates are higher than internal succession. So I have a little trouble with the mercenary CEO that gets brought in outside of an utter turnaround scenario. If the company's on a good trajectory, I think that's usually a lower probability outcome for the company, for the shareholders, for the board, et cetera. But with that aside, the founder has the advantage of, generally speaking, there is no job within the company that they can't relate to that they can't get involved in, and that they won't bring passion to if they're trying to solve a problem or put out a fire. Professional CEOs, generally speaking, run the company from a cockpit. Obviously, it depends on how mature the company is. So they can operate at 30,000 feet, and maybe they can even hover above the ground, but they're not going to be the gardener who gets into the dirt and sticks their hands in. So the advantage the professional CEO has, they're really comfortable with the cockpit. They're really comfortable with a metrics-driven approach to move a company forward. And there are companies that reach a stage where having that as the primary skill of your lead operator, super useful. And then there are times when you got to get your hand in the dirt. And more often than not, that is founder energy. I don't actually ascribe to the idea that there's founder mode and manager mode. I actually think that is a dangerous piece of rhetoric that's out there. I think we might talk about that at some point in this pod. But I do think there are trade-offs between the mercenary CEO who comes in from the outside and the founder who grows up into the lead operating role.
Do you think all founders have the potential to become great managers, or are there cases where it's better for a founder to just step back and bring in someone else to manage the company?
I'm going to modify the premise of the question a little bit. I do think that all founders have the capacity to become a great CEO. That's different than saying they could become a great manager. We have one of our companies as an example. This is a thriving business. This is a profitable company that bootstrapped. It's double-digit revenues. The founders make a lot of money, and they want to grow the company substantially. But the company's kind of hit a plateau on team size and revenue. And every quarter, the founders come with a really a buffet of ideas that are worth exploring and investigating about what might grow the business next. But the percentage of those ideas that actually get to the finish line hall is really low because neither founder is actually a very good manager. And so we had a very honest conversation as a group. When we said to them, ideas are not the problem here. The problem is that we actually lack the execution muscle to get to the next stage of company development. And so we have three options. Founder one, you learn how to be a manager and you put it first. Founder two, you learn how to be a manager and you put it first. Or three, we go find someone else to do it. And we had very honest discussions as a group, ultimately leading to us hiring a chief operating officer and empowering her to be the manager of the business. We kept the two founders in their areas of expertise, including one of them as CEO, and he is and getting to be a better and better CEO. But he'll never be a great manager, and that's okay. He knows it enough to be able to bring in that layer around him and manage that person.
Well, and so what's the biggest opportunity for founders when they learn to become, CEOs? You have any success stories about companies you've worked with?
We've had the benefit of now working with 165 of these over a decade, so we've seen the game a lot. I think what makes us a little different is one, unlike most folks who hang a shingle as an advisor, we're not an equity-only hobbyist that shows up once a month for coffee and says, what do you want to talk about? But please first give me 20 minutes of a reminder of what you do and where you are in the business. And nor are we a coach that spends most of our time on the therapy side of life. Instead, we have a very strong point of view on what it means to be a great CEO. And we have a very strong point of view on how does a company need to mature to get to its next milestone, whether that's getting to seed stage or getting to A or getting to B or getting to profitability, et cetera. And every time we take on a company hall, we put them through, for lack of a better phrase, a two-part audit. What has to change about the business to get to the next milestone? It could be go-to-market related. It could be product related. It could be financial planning or business design related. And then second, what has to change about the CEO to become the CEO, be the kind of CEO this company needs at this stage? That then informs the work that we do. So the challenges we often see, I'd say the most common ones, most founders don't know what planning means. So they don't actually understand bottoms-up math. Most founders are bad at hiring. They fall prey to reciprocity bias. They fall prey to halo bias. They don't understand that there are ways to reduce groupthink and reduce bias to massively increase your hit rate on the next human you're going to hire. And related to the first one, a lot of our founders deeply understand their product, but they actually don't deeply understand either their math or their go-to-market model. If they don't have a unique point of view on how to acquire the next customer or the per unit economics of that exchange, of that arbitrage, then they might be building something that's cute, but not actually interesting. Those are the most common ones, Hall, if that answers your question.
So tell us more about Enjoy the Work. How is it different from the competitors in the space?
I started to answer that a little bit before and kind of skipped over, I guess, the second part of your question to give you some examples. So maybe I'll try and fold those together. And I'll leave some names out to protect the innocent. So, one of our companies, two co founders had had a web dev shop out of Toronto for years. They built apps, they were good at it, they made a nice living from it. And they built a new app that was really interesting where they were able to suck in the video data from construction sites and evaluate what they were seeing off their video feed to better understand and predict the timeliness, the budget efficiency, et cetera, of a large scale construction project from video to planning. That didn't exist in the world yet. So they were curious about working with us. But right now, they had a small services dev shop that was pumping out apps to clients. They didn't know how to get from here to there. So we taught them how to sell that business. We taught them how to raise capital for the new entity, how to hire for the new entity, how to get first product in market that was from the new entity itself, how to build a repeatable go-to-market machine, how to understand the math of that, how to raise additional venture capital, and then ultimately how to work backwards from what ended up being a very successful exit to what is now a public company. Coaches won't do that kind of work. Domain advisors, whose primary role is to open a door in a given space, don't do that kind of work. We do business design, and we're intimately involved with the founders. And so I can tell you on the other side of that, the two co-founders would both raise their hands and say they're better operators today than they were when they started the business, and not in an accidental sort of way, in a methodical sort of way that we figured out what does the company need next and what do you need to learn how to do next. And second, they both got to material wealth for their families, where I think, I don't want to speak for them, I think both of them would say they had a much better outcome as a result of working with us than not working with us. That's one story. I'm blessed to say after 10 years, we have dozens more.
Well, I always ask this question as a mentor and advisor, what online information source or tools do you find most helpful in your work?
So we're voracious readers. It's hard not to be. Some of my partners more than others, and then they share. And 3 times a year, we do an offsite where all of our partners meet somewhere in the world, and we spend a lot of the sessions all just teaching each other things. It's very fun. It's a nice way to not do this work alone. Some of the more common things we read, NFX's newsletter is very good. First Round Capitals gets our attention quite often. Mark Suster's blog post is still outstanding. My favorite out there is Lenny's newsletter and Lenny's podcast because it's such a good aggregation. Because this will sound odd, I'm such a technology laggard that have been trying to read more and more AI first publications of late. The Neuron's really good as a small shot out there. And then we absorb a lot of books. I think some of the recent ones that I've enjoyed, I've reread Five Dysfunctions of a Team for the 45th time because it's still my favorite startup book of all time. And it's good to remind myself of the lessons. Just recently absorbed Scaling People. I wish I could tell you the title, the author's name. I think I have here. Unfortunately, I don't. That book was excellent and super useful. Now, I hope that was a sufficient answer. If you want a longer list, I'm happy to email you one.
No, that's very helpful. I always use that for discovery, and that's a great list there for me to go through. Getting near the end here, there's a dialogue underway now on the founder versus manager theme, which Paul Graham catalyzed recently with a blog post. I found it quite interesting, and it stirred up quite a debate. What was your take on that dialogue?
I don't know him. He's a luminary in the space. And I think on this topic, despite having read maybe everything he's written over the last at least 20 years and really enjoyed a lot of it, I thought this was so misguided. And in fact, more than misguided, potentially dangerous. It felt like potentially giving a founder an excuse of like, no, you don't have to do your job. You don't have to learn what it means to be a CEO. It almost was describing manager mode in a disparaging way, as if elevating from the business of delegating, of empowering others, of finding leverage through others was a negative. as opposed to mastering. There are times to go deep, there are times to zoom out, and to have the ambidextrous skills of someone who can know, like, oh, this needs a founder. I'm going to go sell this deal myself. Or I'm going to go work on this journey map with my customer success team myself. Or I'm going to go get involved in this specific sprint myself. Versus those are working in the business and won't actually move us forward. And I'm just doing this because I like it. What the company really needs is our math is wrong and we need to revisit business design, or we have some dysfunction in the board and I need to go put in a lot of cycles one-on-one to go rebuild trust. And I felt like this founder mode discussion was almost this indictment of a professional manager, when in fact, I want every one of my CEOs to be a master professional manager and then know when to use those skills and when not to.
Well, I looked at it as founder as the inventor, the manager is the optimizer. And as we move into the world of AI and, things can increasingly speed up, it seems like we're going to be doing a whole lot more inventing than optimizing in the coming years. What's your take on that?
I think that's true. What I also think is that companies are still going to go through the same stages of development. Maybe they'll go through some stages faster, but they're still going to go through the same stages. There's going to be a period of invention where I'm going to convince myself that, yes, there's this pain in the world worth solving. And I'm sorry, I don't see how AI is going to get in the way of the founder doing the legwork necessary to see, is this problem we're solving, is it pain big enough? And then second, I need to prove I can solve that pain. Okay, that's a product validation phase. Number three, I need some business model work. I still need to figure out whether or not there's an arbitrage for attracting my customer, winning my customer, deploying my customer, thrilling my customer in a way that's economically advantageous to them and to me. And then after that, I need to figure out a way to fill my top of the funnel in an utterly reliable way. And then I need to make sure my operation can grow at a pace where it can handle all of this demand. Oh, and then finally, how do I start turning these revenues into actual profits and stop burning money? I don't care your company, you're going through those 6 stages. Will AI make some of those easier or faster? Sure. Is it really going to move us from invention into company building and therefore optimizing that much faster? I don't buy it. And
Well,
again,
it's a great
Paul, I
debate.
apologize for all the caffeine.
Moving on, though, we always like to find out, your experience with Enjoy the Work. What is one thing you've encountered while running it that you didn't expect?
So when I left my last startup, I knew I didn't want to run another one. I didn't know what I wanted to do next. I just knew I didn't want to run another startup. So I started to meet with CEOs and investors, and I had this rough idea of how I wanted to show up in the world. I wanted to be able to teach. I wanted to be able to spend time with founders, but without an operating responsibility. But I really didn't know what it was. And I had a founder quickly say to me, within a few weeks of me having these kind of conversations, hey, can we just chat? Because you've already done what I'm trying to do. And then I met a second one, then I met a third one, then I met a fourth one. And after I had 4 of these, Hall, I realized, okay, this isn't me. Like, I'm good at what I do. I'm reasonably confident. But it was so easy to get founders to say, yes, I want to talk to you once a week, that what it called to attention to me is like, there's some hole in the market. There's some gap in the world. What's the hole? The thing I didn't expect to see is how there's absolutely no one that is fully and undeniably on the CEO's side. Truly heavy wears the crown. Like, heavy bears the crown, is the crown, is the crown. There is if you are on the preferred side of the cap table, you are not a fully safe audience. If you are a board member with fiduciary, you are not a fully safe audience. If you are a co-founder with purely technical responsibilities, you're not a safe audience. If you're a spouse, you're not a safe audience. I never even having been CEO, I didn't realize just how painful that was and how it led to this enormous pent-up demand of a CEO who wanted to ask, hey, can you teach me this? Because I've never done this before. And they have no one in the world to ask that safely to, that's actually invested either emotionally or as an employee or as a partner or as a board member into the company.
It's very, very good. So, well, in the last few minutes that we have here today, what else should we cover that we haven't?
If you don't mind, I'd love to turn that around for a minute. Which parts of what I've said so far, if any, your reaction is like, "Nah, I don't buy that." Our our firm's a little different. Like, we don't look like any other advisory firm out there. We have a very strong point of view. You've been investing successfully for a long time. You've managed all sorts of founder situations. Which part of what I've said, you're like, "Nah, I don't buy it."
The markets change over time, and that's the challenge with investing. You just can't keep doing the same thing over and over again. The sectors shift and change, the market dynamics move in unpredictable ways. And so the question that comes up is how do you make that work in so many different economies? We were pre-pandemic, we were in the pandemic, we're now post-pandemic. And those are three very, very different worlds. How do you manage those market shifts that are now coming so much faster than they used to?
I'm trying to answer this without it sounding like a cop out, but even in my head, it sounds like a cop out. Paul, that part's not my job. So
Huh?
in pre-pandemic life, the markets were so good and companies were raising capital and they were growing. They were coming to us with, I have this unbelievable opportunity and I don't want to screw it up. And what my firm can authentically say is, we know the mistakes most founders make. We'll help you not make them. We'll help you make new mistakes that are unique to your product or your business or your team, but you won't make old mistakes. And there are hundreds of old mistakes. Okay, then we get to the pandemic, and suddenly the way of going to market has to utterly change. Very briefly, the world freezes, capital freezes, enterprise selling freezes. And what we learned really quickly is that our founders didn't fire us because they put up their hand and said, wow, it just got harder to be an operator. I need all the help I can get. Now, interest rates go sky high, post-pandemic world, and capital has been beyond scarce for a while and exits have disappeared. And we have all of these founders now who have to operate like the last round of capital they raised is the last round of capital they'll ever raised. And none of them ever were planning to behave that way. None of them were planning to be operators that actually got to more cash in than cash out. And we've done that a lot in our careers. And so even though the markets have really shifted, the way to sell, the way to reach customers, capital markets have shifted, the burdens of being a good operator, if anything, they've gotten harder. And being a good operator is being a good operator regardless of market. I didn't get you. So tell me.
I was trying to think, it's interesting response there, but I really wonder if the customer would buy into that. Would they really
Which
accept that, or would they?
Who's the customer? Who's the
Would they say
customer
that
in
you
this
said as a
example?
cop out? But I think maybe customers would demand more from you. But what do you find? Do you find they demand more or no?
They demand different. I'll tell you that energetically, do you have a physical trainer by chance, or have you ever played a sport? Have you ever had someone kind of standing over you, holding you accountable?
I've had trainers before. Yes.
That's how our founders behave with us. We're holding them accountable. So there's both this track of here's what has to get better about the business. And then here's this track of what has to get better about you. And we sign up together and we codify it. And we're like, here's what success looks like a year from now for you and for the company. Here's what success looks like 90 days from now. So we know we're on the right trajectory. And that looks unique to each one of our founders. And so what showed up in those lists, Hall, has certainly changed as markets have changed. But the idea of the list hasn't changed. So for some of our businesses, selling got harder. And so they demanded more from us on our go-to-market skills, on teaching them how to go from founder-driven sales to a repeatable machine. For some of the businesses, raising capital got harder and they had to put it out further. And so financial planning got way harder. So we taught them how to build a bottoms-up model. We would actually do simulated board meetings where we beat the crap out of their model before they had to show up in front of the people that actually count. So the type of work we changed, but we stopped training them on how to do a preemptive financing 2 years ago or how to do a giant secondary round. That stuff stopped mattering after 2021. We also stopped teaching our companies how to do M&A transactions and how to buy other businesses because that stopped. But we did teach our companies how to go work backwards from the acquisition you eventually want if you no longer believe you're going to be able to raise the next round of capital. We do that work a lot. So what's on the menu? Like the overall menu hasn't changed. What our founders are ordering has.
Well, that makes sense. That makes sense. Well, I want to thank you for going on this journey with me today. It's been a great ride. I learned a great deal. How best for listeners to get back in touch with you?
Two ways. One is our website's really easy to remember. It's called enjoythework.com. That name is not an accident. We like working with good people trying to do hard things. That's the stuff we love how to do. So come to the website. For me personally, just find me on LinkedIn and send a connection request. If you're a founder and you think that there's any kind of gap between how your business is performing and how it could be performing, and you want to just have a chat, I'm easy. Jonathan Loewenhar. It was a pleasure, buddy. Hall, thank you. This was very fun.
Great. We'll include your contact details in the show notes. Thank you for joining us today and looking forward to the next time we get together. Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.